Jeff Lewis, global market strategist at JP Morgan Asset Management, as well joins in from Hong Kong. Jeff, hi, morning. The two-day FOMC meet is going to conclude today. The street has ruled out any fireworks. Are you also working with the same assumption?
Yes, we are. We think it is very unlikely that the Fed will make any material changes to its statement. It will want to keep the boat calm, and it will probably keep a similar language to the last FOMC meeting. So I don't think it will come out with a clear statement on when tapering is likely to start. I think that's a decision which is going to be data dependent, and they're not going to want to tie their hands.
Jeff, do you expect to hear anything on the word tapering at all?
Not explicitly, no. I don't think they're going to give any explicit statement. I think they are going to start tapering when they think the economy is strong enough, but we're certainly in a patch of relatively weak data at the moment, which will probably justify the postponement that took place in September. So I think the Fed will be digesting the data for the fourth quarter. Also, we have the fiscal issues are still going to reappear in February. So I think they are in wait-and-see mode as much as anybody else.
Jeff, the Indian Central Bank has hiked the key rates by 25 basis points. A, would that be enough to counter inflation? And B, how is the FII fraternity really viewing this move?
Well, I think that's a very good question. We're seeing some determination from the new governor to confront inflation, but it's very difficult for him because we're in a slow growth mode and activity is still decelerating. But also, of course, we have the big gap between the consumer price index and wholesale price inflation in India. And I think there's some expectation among investors that they would like to see a bit more weight given to the CPI, which is the normal measure of inflation that central banks try to influence in other economies. So I think there could be another rate hike in the cards in coming months.
Jeff, but historically, equities as an asset class, it does rather poorly when interest rates move up. This time around, Indian markets are moving up, even though the central bank is committed to increase rates.
I think it's right that equities do poorly when there is a structural inflation problem and the central bank is having to hike rates and is behind the curve. Arguably, the RBI now is much less behind the curve. Some of the recent increase in inflation was due to fresh food prices and not really structural factors. But I think the reason that the market is moving up probably is because of the better global news that we've been having.
Jeff, Indian equities as well are sitting at a fresh 2013 high. Do you think that this rally may actually ease out or fade out once tapering actually kicks in?
Well, I think when tapering kicks in, it's possible we will see some disruption to global financial markets, but I don't think it will be on anything like the scale that we saw over May to July. After all, investors have had plenty of time now to reposition their portfolios, so there could be some short-term reaction, but it won't be anything like as bad as it was this summer, I don't think.
Jeff, for the better part of this year, we've seen a comparison in global equities. So either it's DM or EM. Sometimes it is EM followed by DM. But as of now, all emerging markets and all developed markets are moving in a synchronized manner. Do you think the way to approach equities is that we should look at equity as an asset class in totality rather than focusing on only EM or DM?
I think that always makes sense, yes. We believe very much in maximum diversification across asset classes and across regions and geographies within a major asset class such as equities. So I think it would be a very difficult game if you were running a portfolio by switching very actively from DM to EM and back again. I would rather be exposed to both classes and look for opportunities within each universe.